The pandemic continues to impact the economy, and the Federal Reserve just indicated it'll raise interest rates in the coming months in an effort to fight inflation. Now, the central bank's decision to pursue a more aggressive policy will have ripple effects on the stock market and your wallet. So let's bring in Michael Cox. He is an economist in residence at SMU Cox School of Business and former chief economist at the Federal Reserve Bank of Dallas. Michael, the housing market is red hot right now. If someone's applying for a mortgage this year or buying a car, how much could this affect their payments?
Well, it's already affecting their payment. Mortgage rates are up by a full 100 basis points over the past year and a half, precisely because the Fed has not raised rates already. They have been fixing to just do it for over a year. Meanwhile, inflation has crept up to over 10%, and that's what's affecting mortgage rates. We're seeing inflation expectations now go up with inflation because the Fed has just cried wolf and not done its job of stopping it. And so those inflation expectations are being incorporated into long-term interest rates, such as mortgage rates, Chris. And that is already affecting interest rates. So if they don't do something and quit talking about doing something, it's going to get worse.
All right, well, a little bit too much hinting, not enough action. It's been almost 2 years since the Fed slashed rates to zero. Granted, trying to salvage the economy at the onset of the pandemic. Will raising them now bring any actual relief to everyday prices?
Not now. It'll take a while. But if they don't do something, we're going to have two problems. The Fed has been trying to fight this slow economy, this 2% growth, with money, but money was never the solution to this problem. The problem was we had about 5 million people who did not go back to work after COVID hit. And we had a labor market. But now the unemployment rate is down to 3.9%, and we just about exhausted all the routes we can for getting those people back to work. So money was never the problem. But if in trying to solve the problem with the wrong tool, what we created is another problem, and that's we have double-digit inflation. I want you to know that during this current chairman Powell's term, we have had the biggest increase in inflation in any chairman's term since G. William Miller. You have to go back to 7 chairmen before you will find this big an increase in inflation. G. William Miller let inflation go up by 5% during his term. Paul Volcker had to come in and take it down. Alan Greenspan had to do some more to take it down, followed by Ben Bernanke, and in no other Fed chairman have you seen this much of an increase in inflation. So I'm very distraught by how much this Fed chairman has let inflation get out of the bag.
And Michael, one last question. How does this affect savers? Maybe folks who may be a little averse to putting a large chunk in the stock market. How does it affect them?
Well, since interest rates, especially short-term interest rates, are very, very low, and interest rates and inflation is high, this means that your real return after inflation on your savings is negative. It means that the real value of your money, the purchasing power of your money after you get back the interest on what you invest in short-term securities is negative. It's worth that money. The value of that money is worth less tomorrow than today. And of course, inflation is bad for the stock market too. And so we've seen this rise in inflation also take the stock market down to those lowest level in a couple of years. So it's been bad for investors all around.
All right, economist Michael Cox from SMU. Thank you again for giving us
Thank you, Chris.
some great context.